Hi, I'm Fred Ruffy with Trade Alert, and today I'm going to talk about the recent shift in investor sentiment along with a potential strategy play for the rest of 2012. Obviously, since Tuesday, there's been a dramatic change in investor sentiment. The S&P is up a bit today, but after a big two-day decline, we saw VIX move back up above 19 for the first time in months. The volatility index is back down towards about 18, but still other indicators suggest that investor sentiment has really become very bearish. And one indicator is the put-call ratio. We look at the put-call ratio, stripping out unusual activity or rather high call volume due to ex-dividend trading. When you take out that activity, the high call volume that we saw Wednesday due to ex-dividend trading, we see the put-call ratio spike to 1.08. That's the total for all trading across the exchanges. And then a very extreme yesterday of 1.15. We also look at the premium going into puts trading versus call trading, and that is also at multi-month highs. So very negative sentiment reflected in the put-call ratio, just looking at trading activity across all the exchanges. In fact, yesterday we saw a very large trade, actually two large trades in two of the exchange traded funds. One was, it was a 104,000 contract block of November 40.5 puts on the iShares Emerging Markets Fund, ticker EEM. This was a very big trade, the largest single block of options that we've seen in weeks. The exchange traded fund is around $41, so this was a downside put purchase for 38 cents, basically betting that global equity markets would remain volatile through the end of next week. And then another really large trade we saw yesterday was in the XLF, the SPD, the Select Sector Financial Fund, which is around 1550. It was a large buyer of 96,000 contracts of the January 15 puts, also for 38 cents per contract. Those expire in 10 weeks. Again, a huge downside put buyer in XLF and one in EEM. So these are large trades, possibly hedging activity, looking to hedge portfolios, or maybe outright bearish bets. We can expect the volatility to continue through year end due to concerns obviously about the fiscal situation, and also remember that the market decline really got underway in mid-September, and that was driven by earnings and concerns about revenue growth from many large cap, especially technology companies. So what do we do? Year end, the S&P 500 still up over 10%. We might have some gains in some of our stocks. One thing we might want to do if we expect the volatility to continue is to consider a stock replacement strategy. By that I mean if you have a winning stock, you can exit it now, and rather than holding the shares, try maybe consider a bullish risk reversal where you're buying calls and financing that with downside by selling downside puts. Right now in this market, that's an attractive strategy because implied volatility is still low, but there's still a lot of skew in downside puts. So what you're doing is you're selling your puts below the market, and if there is a market decline heading into 2013, those puts could be in the money at the January, and I'm talking about January risk reversals, and then you're buying the stock again at a lower price because you're being assigned on the puts, but at the same time, you're holding long calls. And so if there is a market rebound, you're also still participating in the upside. So the idea is basically take a winning stock position. If you're concerned about, giving back some of those profits through year end, replace that stock position with a bullish risk reversal, selling out of the money puts, buying upside out of the money calls. Thank you. I'm Fred Ruffy, and I'll see you next time.